Good morning, this is TOI Japan Market Radio for Friday, April 10, 2026. I'm your host coming to you from Tokyo. For global investors tracking Japanese markets or managing Japan exposure, today's session brought us a mixed picture across equities, currencies, and rates. Let me bring in our portfolio manager to walk us through the numbers.
Thanks. So looking at the headline indices, we saw the Nikkei 225 close at 56,924.109, up 1.841% on the day, which was a pretty strong move. TOPIX, however, was essentially flat, down just 0.05% to close at 396.5. That divergence tells you large cap exporters did the heavy lifting today. The Mothers Index, which tracks smaller growth names, gained 0.283% to 2,477.0, and the J-Wright Index edged up 0.052% to 1940.0. On the currency side, dollar-yen moved to 159.131, up 0.308%, so we're seeing continued pressure on the yen.
And just to round out commodities, gold in yen terms rose 0.985% to 17,940.0, while crude oil slipped 0.296% to 97.58. So a bit of a mixed bag there as well. Now, turning to the main drivers today, we had several headlines out of the US that are particularly relevant for Japan watchers. First, U.S. consumer prices came in as expected for March, showing that inflationary pressure in the states remains elevated. What's your read on how this plays into the Japan story?
This is critical for anyone managing Japan positions because it reinforces the policy divergence theme we've been living with. The Fed is still dealing with persistent inflation, which means U.S. rates are likely to stay higher for longer. Meanwhile, the Bank of Japan remains accommodative, and that interest rate differential is the primary driver behind yen weakness. For Japanese equities, particularly the export-heavy names in the Nikkei, a weaker yen is generally supportive because it improves overseas earnings when repatriated. That's part of what we saw today with the Nikkei's 1.841% gain.
Right, so the currency effect is working in favor of exporters. What about the bond market and yields? Are we seeing any pressure on JGBs from this U.S. inflation print?
Interestingly, not much. The dynamic here is that while U.S. yields might tick higher if the Fed stays restrictive, the BOJ is still anchoring the long end of the Japanese curve. So we're not seeing significant upward pressure on 10-year JGB yields. In fact, the dovish stance from the BOJ contrasts sharply with Fed hawkishness, and that keeps Japanese yields relatively stable to lower. For global investors, this means the carry trade remains attractive, borrowing in yen to invest in higher-yielding dollar assets, which further pressures the yen downward.
That makes sense. Staying with the inflation theme, there was also chatter earlier in the week about U.S. stock futures holding steady ahead of this data release. The market seemed quite calm, waiting for confirmation. How does that kind of positioning affect Japan specifically?
When U.S. futures are steady and in a wait-and-see mode, it generally means global risk sentiment is balanced, which is constructive for Japanese equities. Japan's market tends to take cues from Wall Street sentiment, especially for the tech and cyclical sectors. If the U.S. data had surprised significantly to the upside or downside, we would have seen more volatility spill over into Tokyo. As it was, the data came in as expected, so we avoided a shock scenario. That allowed the Nikkei to rally on the yen weakness story without being derailed by a sudden shift in risk appetite.
Got it. Now, shifting to the energy and geopolitical side, there was significant news overnight about oil prices. Crude opened higher on reports of a potential ceasefire between the US and Iran, which would obviously reduce tensions in the Middle East. Given Japan's dependence on imported energy, this feels like a big deal. Can you walk us through the implications?
Absolutely, this is a major development for Japan. Japan imports roughly 80 to 90% of its crude oil from the Middle East, so any reduction in geopolitical risk in that region directly benefits the Japanese economy. A ceasefire reduces the risk of supply disruptions, which stabilizes energy costs. That's important not just for inflation expectations but also for the competitiveness of Japan's manufacturing sector, which is very energy intensive. Lower and more stable oil prices reduce input costs for industries like chemicals, utilities, and the big trading houses.
And how does that filter through to equities and the yen?
On the equity side, the impact is modestly positive but probably not dramatic. Energy-intensive sectors like trading companies, utilities, and chemicals should see some benefit from lower cost uncertainty. However, the Nikkei's performance is much more driven by the tech and export sectors, so oil is a secondary factor. That said, if oil prices were to fall materially over the next few weeks due to the ceasefire holding, that would be a tailwind for corporate margins. On the yen side, if the ceasefire improves global risk sentiment, you could see some modest upward pressure on the dollar as demand for safe haven yen weakens. But again, the primary driver of dollar-yen is the rate differential, not oil.
Right, so it's supportive but not a game changer. What about the bond market? Does lower oil have any read-through to JGB yields?
The connection is more indirect. Lower oil prices would reduce near-term inflation expectations in Japan, which could put gentle downward pressure on 10-year yields if energy costs decline in a sustained way. But the effect is minimal unless we see a significant and lasting drop in crude prices. The BOJ's policy stance is still the dominant factor anchoring yields, so I wouldn't expect a major move in JGBs purely from the oil story.
Understood. So to summarize the ceasefire angle, it's a net positive for Japan, particularly for energy costs and inflation expectations, but the market impact is relatively contained. Now, bringing it all together, we had U.S. inflation data reinforcing the Fed's restrictive stance, a potential Middle East ceasefire easing energy concerns, and futures markets that were relatively calm ahead of the data. How should global investors be thinking about Japan right now given all these crosscurrents?
I think the key takeaway is that the policy divergence trade remains very much intact. The Fed is staying restrictive because inflation isn't going away, and the BOJ is still accommodative, so the yen is likely to remain under pressure. That's a tailwind for Japanese exporters and a headwind for importers and domestic consumption plays. On the equity side, the Nikkei's strength today, up 1.841%, reflects that dynamic, with large cap exporters benefiting from the weaker yen. TOPIX being flat suggests the broader market is more mixed, which makes sense given that it includes more domestically focused names.
And what about the risk factors? What should investors be watching closely over the next few sessions?
Two things primarily. First, any shift in Fed rhetoric or US data that changes rate expectations will immediately flow through to dollar-yen and Japanese equities. If the Fed signals it might ease sooner than expected, you'd see the yen strengthen and some pressure on export-heavy stocks. Second, watch the Middle East ceasefire developments. If tensions flare up again, oil prices could spike, which would hurt Japan's import bill and raise inflation concerns, potentially forcing the BOJ's hand on policy normalization. For now, though, the base case is a weaker yen, stable to lower JGB yields, and selective strength in Japanese equities, particularly exporters.
That's a very clear framework. So for global investors with Japan exposure, the message is to stay focused on the rate differential and yen dynamics, watch energy developments for inflation implications, and position accordingly in exporters versus domestic names. No dramatic shifts expected in the near term, but these crosscurrents are worth monitoring closely.
Exactly. And I'd just add that volatility could pick up if we get any surprise out of the BOJ, though that seems unlikely in the immediate term. The bank has been very clear about its gradualist approach to any policy normalization. So for now, the path of least resistance for dollar-yen is probably higher, and that supports the large cap export story in Japanese equities.
Great insights as always. That wraps up today's briefing for April 10, 2026. We covered the Nikkei's strong performance, yen weakness driven by US-Japan rate divergence, the potential Middle East ceasefire and its impact on energy costs, and the broader implications of US inflation data for Japanese markets. If you're a global investor following Japan or managing exposure here, make sure to stay tuned to TOI Japan Market Radio. We'll be back on the next trading day with more analysis. Thanks for listening.
Thank you.